much. Can everyone hear me now?
We can hear you now. I think it's clear now.
Apologies for all of that. Good evening, everyone. And it's a delight to welcome us to the September 2022 edition of the Business Growth Series. It's always a lot of joy having this every month and seeing that people are in the room to glean as much as possible. MSME Africa is Africa's leading platform for news, community, tools and resources for micro, small and medium enterprises in Africa. And we're always delighted to help the next MSME to overcome their challenges. And I'm extremely delighted today that today we're talking about alternative finance route. I don't want to let the cat out of the bag. I'm going to leave the moderator to introduce our speaker. And I can assure you that it's going to be a very awesome time in the room. And so I welcome everybody once again. Have a good time. All right.
All right, Mr. Shayed, thank you so much for your opening message. So right about now, we are going straight into the for tonight. Something quite interesting for this particular point in time. And we're looking at the future of small businesses with focus on expanding operations with alternative financing routes. Today we have our guest speaker, Jonathan Ike Olumba. I don't know if you can put up his profile so I can take that quickly. Okay, let me just go ahead. Jonathan Ike Olumba is a certified chartered accountant and finance consultant with different business structures and operating models. He is very passionate about solving complex business problems and helping businesses create value. His core area of specialization is in financial management, years of experience across roles in banking, development, finance, and consulting. Jonathan Olumba has collaborated with notable Access Bank, Institute of Chartered Accountants of Nigeria, ICANN, Bank of the Industry, Development Bank of Nigeria, Cherry Blair Foundation for Women, Faith Foundation, Tony Elumelu Foundation, Mastercard International Finance Corporation, and many more. Mr. Jonathan is currently the managing partner of Office Lord Consulting, which is a finance and strategy consulting firm, an international finance corporation, master trainer, and certified assessor. Mr. Jonathan Ike Olumba is a doctoral student of the Lagos Business School and a member of the finance faculty at the Faith Foundation and Enterprise Development Center at the Pan-Atlantic University. I would like us to welcome Mr. Jonathan Ike Olumba to give us his message tonight. Good evening, Mr. Jonathan.
Good evening, and it's a pleasure to be here, but I guess it's cliche to always reconfirm if everyone can hear you. So it would just be nice if I get the feedback, if everyone can hear me.
Well, I can hear you.
I can hear you clearly.
Everybody, okay, that's fine.
All right, okay, fantastic. I wanted to just have an alternative network just in case something goes wrong. All right, so let me just start. I'm going to be sharing a slide. I hope I can do that now. So, first of all, I wanted to start by saying I thought it's a privilege to be here. The MSME Africa is building what I will call a strong community of MSMEs, and just helping MSMEs, position themselves for growth and position themselves for fantastic opportunities and offerings. I just thought it was a privilege to be here. So I wanted to start by registering my sort of appreciation for being here today. I'm going to be discussing something today that I think is more important, and I think it also speaks to creativity. I think it also speaks to innovation, and that is about alternative financing routes for scaling your business, for growing your business, for expanding your business. And the way I would like to start is that, traditional financing is fraught with a couple of issues. If I asked anyone here, what has been your experience trying to access funding? I'm sure I might get a myriad of issues, trying to access funding. So what I am attempting to do with this conversation today and with this session is to, first of all, remind you of what the traditional financing routes are, and then more importantly, now tell you evolving or emerging alternatives, to how you can access funding. And I'm pretty sure that this is going to be a very interesting conversation. So I've got 3 objectives for today's session. I want you to be able to identify an alternative finance option if you see one. So that will be the first objective that I'm setting out for this session. I also want you to understand the benefits. Why would it be beneficial to go for an alternative finance as opposed to a traditional finance? And then more importantly, what are the documentations? What are the criteria? What are some of those things you would need if you wanted to be able to access those financing? I'm going to share that with you. So those are my triple objectives for today's session. So I start by making a point that it's a research that has been done, has been validated, and I'm even sure MSME Africa participated in this, because I took this from a research from PwC, the past research they did. And this is clear that many MSMEs don't survive up to 5 years. And the major reason really for this lack of survival for more than 5 years is finance skills. But more importantly, within finance skills is even access to finance, right? And there are several reasons for that: cost of finance. So I just wanted to start by that. So let us go into the traditional sources of finance. But let me make this very interactive by guessing. When I say traditional sources of finance, what has always existed? What are the major routes? If you are thinking about getting finance for your business, what are the options that will come to your mind, right? So I will tell you something for free, that the traditional sources of finance are 2 types or 2 sources. So let me now throw this open. If I ask the class, and please put it on the chat box, what are the traditional means of accessing finance as a business, as an MSME? What are your typical options? What comes to mind? So please put it for me on the chat. What are the options? What do you think about when you think about accessing finance? So I'm saying family and friends, I'm saying loans, I'm saying family, I'm seeing family and friends. I'm seeing self-financing and family, commercial banks, savings. Yeah, I like what I'm seeing. Go on, let's see. So there are predominantly 2 types. Yeah, so grants, I'm seeing grants. I'm seeing venture capital. I'm seeing crowdsourcing. Some of you are already preempting what my session is going to cover. Someone is asking what is Akawo. I don't know as well too. So I think it's good that I like to call her Auntie Fayo is asking what is Akawo as well too. Isusu, all right. Angel investors, Joe. All right. Nice to see all these options. Exactly. Someone is almost, spot on here, right? So for me, the traditional means of accessing funding has been to look at these routes, equity and debt, right? So, and many of the things you were all speaking about, so whether it is venture capital, angel investors, family and friends, I'll put it to you that they fall under equity or debt, right? So, and I saw people say Ajo, I saw people say loans, commercial banks. All of what you've said, you're all correct. It was only 1 or 2 people who spoke about alternatives. So just to say that you're all correct with what you've said. And I am going to be proving that to you that you're correct by just telling you where they fit within this box. Okay. So there are predominantly two types, right? Equity finance and debt finance. So let me now explain now. So when we say equity finance, think about equity finance as basically finance from the owners of the business, or finance from the people who have invested in the business, right? So just think about it that way, as the owner's finance or people who are investing in the business. And examples of this equity finance would include the money put by those who start the business upon formation. Also to family and friends. This was fantastic. I heard many of you say family and friends. So when family and friends put in funds as well too. Then we've got business angels. Business angels are people. So the focus for business angels, or some might call them angel investors, are for businesses at ideation stage, at conceptual stage, right? And these are businesses that are trying to come up at least with some sort of proof of concept, and they would help those businesses fine-tune and stress test that proof of concept, and then prepare those businesses to be able to then scale, right? So that's what you mean business angels, and I'll give you a couple of them as examples. Another very common one, but I don't see a lot of people take advantage of this, but this might not really speak to MSMEs, maybe this might be growing MSMEs, is to take advantage of the capital markets. So in our capital market here in Nigeria, we have what we call the growth board. I don't know if anybody, and it will be nice to see if you put on the chat, has anybody come across the growth board, or have you heard of this terminology before, the growth board? Please put it for me on the group chat if you have on the chat. Okay, so I'm saying no. Okay, so Justina says no. Yeah, Kola says yes. All right. Okay, so basically in our stock exchange, we have a smaller stock exchange for smaller businesses. And the way to look at it is that the listing requirements is quite very reduced. So for example, if you do 50 million naira in annual turnover, you can get listed on that stock exchange. Also too, the condition is that you should also have prepared audited accounts over the last 2 years. So the listing requirements are quite very flexible. But just to say that, I know a couple, as a last count, I think about 11 businesses were registered on that smaller stock exchange, so-called the growth board. Then we also have venture capital, and this is somewhat like related to the angel investors or the business angels. It's just that venture capitals would not focus on businesses at ideation stage. They will focus on early stage business. So you should have recorded some traction, right? And another thing is that they look out for high growth business. So there are quite a lot of valuations they will do to your business to test, your growth potential. So it's always businesses with potentials to scale quick and to go very fast, right? And so you would find venture capital. So it might be that some of you might have found yourself pitching to venture capitals. So to make this somewhat very practical, I wanted to share examples. And please let me say something. I'm not advertising any of them. I just thought this was a way to make it very practical. So I want to share with you a couple of equity funding options that are available out there, just so you can internalize it. I want to add again, I'm not advertising any of them. I have no affiliation with any of these names I'm sharing here. Was just to make it practical. So your business owner, you as the business owner, your funds are part of it. If you wanted to appreciate what angel investors might look like, there's a Lagos Angel Network. CC Hub runs a growth capital that can serve as a venture capital. There's Ingressive Capital. There's Venture Platform. There's Emerging Nigeria by Mrs. Tony Sani. There are quite a couple of them. I just wanted to share with you examples. Now, for debt capital or debt finance is basically loans that when you use loans to finance your business, and you can get this debt capital from a variety of institutions. So all commercial banks in Nigeria can provide MSMEs, right, with loans that they can use to finance their business. Also, too, depending on your scale, right, as an MSME, you can access capital from microfinance banks. Then there are also universal banks, which is banks that can play both commercial, microfinance, even investment banks. You can. There are specialized financial institutions. So, for example, you might think about Bank of Industry, focused on those doing value addition, focused on machineries, so you can find them. There's also Development Bank of Nigeria as well, too, right? Even we used to have the Bank of Agriculture. So you can find specialized financial institutions that can provide you with debt capital, right? But the thing to note with debt capital is that it is basically loans you have to repay back, right? So you can get them from specialized financial institutions. So I wanted to give you examples, like I've said, and some of this just so it makes sense, right? So if you think about Bank of Industry, they've got some SME managed loans, which are loans for MSMEs, right? The commercial banks as well, all the commercial banks in Nigeria have an SME desk. So if you approach them, they can give you. Not too long, CBN had some specific SME loans, right? So there was the COVID-19 credit facility. Some of you might have accessed it. There was also the agribusiness called the Msme, right? The agribusiness small medium enterprise investment scheme. There was the NISA fund. Even in Lagos State, there was the Lagos State SME recovery funds as well. These were all loans that were required to be repaid as well too. Some financial technology companies, which are called fintechs, are emerging that are also offering loans, right? There are a couple. I'm not speaking about loan sharks, right? But there are a couple of them that do structured loans for small businesses, right? So there's Carbon, there are a couple of them, right? So they do exist. I wanted to share that. Good. Now I have spoken to financial institutions, but it's not just financial institutions that can grant loans. So even non-financial institutions, right? So someone said Esusu, right? So the better name for Esusu really is thrift and credit, right? Or some might call them rotating credits, right? You know, when the credit is structured to be designed that can rotate across its members, right? Some of you call it Ajo, whatever names you call it, right? They are called, the bucket for that is called rotating credits and savings, right? So you might find that you're a member of a rotating credit and savings association. Even within organizations, I've seen a group of people come together to just do some of those schemes, right? Corporate organizations, meaning banking or non-finance institutions, just a corporate organization can decide to actually fund and give out loans to some businesses as well, to donor agencies, high net worth individuals, non-governmental organizations, foundations as well, multilateral agencies. So you can actually access debt capital from them, which are basically loans that you would have to repay. So now I thought before we speak about the core, which is alternative financing, that it was good to speak about the traditional financing. So in a nutshell, the traditional financing will speak to both equity and debt finance, right? Now, I want to share something with all of you before I get into alternative sources of finance. And I want to take you back to accounting 101. I don't know if anybody here, if there's someone here who has never met accounting in any form, right? There is something we call the accounting equation. And this is the accounting equation, right? The accounting equation, which is the concept we use when we prepare our balance sheet, right, says that assets are equals to liabilities plus equity. If there's anyone here who's ever had accounting course, you might have met this, right? Let me ask, is this strange? What I've just put here, the accounting, I just want to find out so I know if I need to explain again in granular terms. Is this strange? Is this something you've met or you've seen before? Just to get a sense of my audience background. So just type on the chat box. This formula here, is this something you've come across before or you've never come across it? I just want to know if I need to explain. All right, so I'm getting, no, it's not strange. No, it's not strange. There's some strange, it's not strange, not strange. All right. So this is the fundamental expression of what you see in the popular financial statement called the balance sheet. When you are trying to express an organization, the financial position of an organization, you express it in your balance sheet. And in your balance sheet, basically, you are preparing the balance sheet along the line of this equation. You will state the assets of the business, and then you state the liabilities of the business, and you state the equity of the business. And the balance sheet answers the accounting equation that your total assets in your business should be equals to your total liability and your total equity. I'm getting somewhere with this conversation. Liabilities are your loans, what you owe, right? And so when you look at liabilities, you see the things you owe and basically think about them as your loans, right? So liability will answer the question of your loans. Or if you like, say the word debt. Equity will answer the question around your equity finance, right? Now, so this is where I'm going to with my conversation. The traditional sources of finance are along the lines of debt finance and equity finance, right? Now, I'm going to share with you alternatives, and they are not far. The alternatives will be on the left side. So this debt and equity, we call it right side financing. So your traditional financing, let me teach you a new term, call it right side financing, because this equation, liability and equity, is on the right side. The alternatives I'm going to be sharing with you answers the question on the left side, which is financing by leveraging your assets. I want to repeat again that the alternative financing are financing by leveraging your assets. So the traditional financing has been around equity and liabilities, which is debt and equity. But the alternatives is on the asset side. So you can take advantage of any kind of asset you have in your business and convert it to financing. And I'm going to explain to you all the various types. All that they have in common is that they are all financing by leveraging your assets. So that's really what I wanted to share with you. So in some terminologies, right, we'll call it left side financing, and that's the alternative now. So rather than focusing on the right side, which is debt and equity, focus on the left side, which is really asset based. So let's get into that conversation now, and I'll begin to share with you a couple of examples. Now, this is quite very common. To be honest, I was thinking to myself, do I put it as an alternative, or do I not put it as an or as a traditional grants, because grants has always been there, but it is an alternative because it's basically not loans and it's not equity. So one alternative way to finance your business is by leveraging grants. And think of grants as, awards that are granted to you because they are not repaid back, right? And you can basically get grants from individuals or corporate organizations or nonprofits. The thing I find with grant financing is that it's always linked to a course. So take, for example, many of the grants you would find is linked to it could be a social cause, it could be a societal cause, it could be an environmental cause, it could be an impact that you're trying to create. And so it is linked to something that the organization is trying to do, right? Some sort of value that you are trying to do, and it will align together with the grant provider. I'm sure you know, I need not to say that grants is very, very competitive, right? But it is, right? So I did say to myself, right, that this is an alternative, but I know it's very common because it's something that you all would find yourself wanting to go for. So the big picture is that it is linked to impact. It is linked to impact. And to some extent, I would like to say it is linked to an intangible value you are trying to create. So I think for me, what really helps you attract grants is you trying to create some value. So I would liken it to an intangible value that you're trying to create, right? So leveraging your intangible assets. So I just want to say that they all speak to assets. So grant is one. So it's an award kind of financing you get. It is always linked to impact, and it can be provided by any of the people I put here. So this has been for as old as you can find, right? Okay, so I just want to state that. So common examples of some of the grants that are available. MSME Africa is always big on posting these grants, like the Tunmelu Foundation. There's also Nourishing Africa as well too. There's the MasterCard Foundation. There's the Flourish Africa. The list is endless. There's the Orange Corners. So there are quite a lot, right? Like I said, I'm not here to promote any of them, but I just wanted to make it very practical, right? So remember again that grants are linked to impact, right? Are linked to impact, and those impacts helps, think about them as creating intangibles, right? So it is linked to impact, and then it's a function of your intangible assets, right? So I'm just trying to prove to you that alternatives are asset financing, right? So that is one. Let's move on again. Another one is crowdfunding. And what is crowdfunding? So crowdfunding, which is really leveraging technology platforms. So you can leverage technology platforms now to access funding from investors. And usually the way it works is that these platforms are out there and they match you as a fundraiser to funders. And so there will usually be a fee that will be charged if your fundraising is successful. And there's a whole list of available crowdfunding sites. The thing with crowdfunding is that you can do crowdfunding or crowd lending. So what do I mean by crowdfunding is that you can use these platforms to raise loans, or you can use this platform to raise equity. So when we really say crowdfunding, really is when you use these technology platforms to raise equity. But you can also do crowd lending, which is you can use these platforms to get loans, raise loans, and you pay back, right? Many of the agri-tech companies, I don't want to promote any name, do that. You a certain percentage and you get your capital payback within 9 months, right? So there are quite a lot of them. Is this clear? Can you hear me? Just a confirmation if you can hear me. If you can hear me, please put on chat box that you can hear me, because I'm getting a signal network being poor. Can you hear me? Oh, fantastic. All right. You can. Now, I thought about the very popular crowdfunding platforms, and some of them as an individual, you can even raise finance, right? But these are very common. I'm sure many of you know about these ones, right? Indiegogo, Kickstarter, GoFundMe, Mighty Cause, Start Engine, Patreon, right? So what is it that makes your business more likely to successfully raise funding through these platforms? What is it that will more likely make your business raise funding through these platforms? I'll tell you something I find, right? And it doesn't have to hold, this does not have to be accurately correct, meaning it doesn't have to be 100%, right? But what I find the most with raising funding through these platforms, because most of the investors have certain metrics that are important to them. But for me, a very important metric is the ability to scale using technology. Because you are trying to access funding, right, from a global audience or from a global funding base. And so what I find with leveraging or trying to raise funding through crowdfunding platform is, aside the value around what you are trying to do, but really it will be the role of how technology can enable you scale your business. So you find that many of them who do this crowdfunding successfully to raise significant funding are leveraging technology. Again, brings me back to the question that technology, which is an asset, right? So it is leveraging your assets to really raise funding. I just tried to show you the relationship that many of the very successful crowd funding are linked to businesses beyond everything, but leverage technology for scale and growth. So if you find you're a tech-enabled business, you'll find that you might be very successful with raising funds through some of these platforms, vis-a-vis other criteria. So it's still leveraging technology, which is a critical asset in your business to be able to access funding. So still speaking to the fact that it is an asset-based means of raising finance, right? But the point is, you can use crowdfunding to raise equity, you can use crowdfunding to raise loan. But I'm just trying to tell you the key success factor to using it. Okay. Another one is accelerator and incubator programs. And this is one that I think many people don't pay a lot of attention to. So there are quite a lot of accelerator programs and incubator programs that they can be structured in two ways. Some of them are structured that upon completion of these programs, you will get to pitch to certain investors. Some partner with investors, because what really is happening with the accelerator program and the incubator program is that you are building capacity, right? So they're both somewhat related, and I try to show that here on this graph. So if you look at incubators, so with incubators, it's about, ideation, early starting, right? And some of the things you find with incubation is that, so for example, they'll provide you with like physical space, to work in. Also, the admissions are quite very flexible, right? And also you'll be provided with capacity building programs, mentoring. Now, for accelerator programs, quite similar as well too. But the thing is, accelerator programs are for businesses that have already crossed the incubation stage, right? So something is demonstrable now, and it's about scaling it quick. So I put here on my slide that is to help early stage businesses that already have, and this is the key thing that distinguish whether it's accelerator or incubator programs. Accelerators focus on business with a viable product that can quickly scale and grow. I think there is a hand up. Somebody is trying to ask a question, and I thought it would be fair. So can we allow the person? I think, Mercy, do you want to help me? I saw a hand up.
Sir.
Okay.
So, okay. Did you want to take that?
Okay, that's fine. So basically, there's a session for question and answer once you are done with your presentation. Yeah. So you may please kindly hold on with your questions. Thank you.
Yeah, I thought as much. Thanks. Okay. So, like I did say, these programs are basically to help you with capacity building, like hand-holding, to ensure that, your value proposition can really be translated quickly, right? And then you would find that many of these programs work with investors, right? So, and because these programs, they work with investors. So some of them inherently, right, you would find that there are funding at the end of the program. Some might say you pitch and the funding might not go around. So the funding might be for the best 3 or the best 5. While some will just work with investors because they've developed capacity. And once they develop capacity, then the next thing is they are matching you to an investor, right? So let me give you a couple of some of them I see, right? So I just loop them together because for me, the difference between an incubator program and accelerator program is incubation really is around ideation and really ideation really, and then shaping up the ideation, shaping up your business plan. Accelerator is you've already got this idea, there's a viable product, let's have that product quickly scale, right? And even the way they structure some of these programs. So accelerator programs will be structured as cohorts. Incubator programs might just be on a rolling basis, right? No fixed duration, just typically rolling, right? And sometimes the way the structure of how they match you with these investors can be is that when they match you to investors, obviously you would have to part some shares with some of the investors. So all those models that I've shared around angel investors, venture capitals, business angels can actually, you might find that those are the people you are pitching to in these programs. So similar to the point I've always made, I'm not here to market anyone, but I just thought these were very common ones. So if you check Google for startups, recently about 15, if I'm correct, 15 African businesses just joined the next accelerator round cohort they're going to do. Co-creation Hub has series of rolling incubation and accelerator programs around. There's the Founders Institute here, there's Faster Capital, there's Startup Bootcamp, Innovation Hub, Adaverse, ARM Labs. Not to promote them, but just to give you so you can internalize some of these programs when you see them, right? Okay. Another alternative way to generate funding for your business is to leverage your unpaid invoices. So I'll call this invoice financing, right? And how does this typically work? So you might find that you've been contracted to deliver on something, right? And you would have obviously delivered on what it is, maybe contracted to provide a product or a service. And usually, especially when you work with very big organizations, multinationals, big organizations, the way they structure their cash flow patterns, they don't pay upon delivery. So there's always a defined timeline, right? They have for making payments based on supplies. And that's for several reasons, right? They've got to ensure that, there's the whole control around verifying what has been supplied, what has been delivered, the whole approval process. So there's usually the payment period, which is always very clear. Sometimes when you go to bid for some of these offerings, it's always clear. Now, if you have delivered and have invoiced some of these clients, right? Obviously, you now have what I will call as unpaid invoices. You've delivered on credit. There are opportunities for you to convert these unpaid invoices to funding. And I'm going to share with you two good examples. One is factoring, and then the other one is discounting. So there are third-party organizations that once they are clear that your unpaid invoice is from a valuable organization that they trust their integrity, they are happy to say to you, we can disburse you with funding, buy it off basically at a price. So they will usually buy it at a discount. So let me speak to invoice discounting, right? They will usually buy it at a discount to the amount that is stated. And I'll give a practical example. So you supply XYZ company product or services, or you provided a service to them, or you supply them products worth 5 million naira. Now, it is possible now that you can meet another company. Let's call the company Sheyero Timi's company. Sheyero Timi can say, oh, you supplied XYZ company worth 5 million. And I know them. It's an organization with repute. Let me pay you 4 million naira. Since you are going to get your money in 60 days time, get 4 million naira today, then I will have to bear the risk of waiting till 60 days time or 30 days time to then get the full value of 5 million. That is financing. You've unlocked finance, because the bigger picture might have been that you might have thought about how you were going to go and borrow from the banks or look for an investor. Like I've said, look for either equity or debt for that duration while you have to wait till your invoices become paid. So those who provide this kind of services are called invoice discounters. So for them, the margin and how they make their money is that because they are purchasing this unpaid invoice at a discount to the value on the invoice, there's some margin for them. Now, there's a slight related example to that called factors, right? So invoice factors or credit factors. Now, it's the same concept, but the difference is that with a credit factor, the person who is supposed to pay you this unpaid invoice is now aware of their existence in the transaction. So instead of crediting you in this case, the 5 million naira now, they would credit Mr. Sheyero Timi's company that has come in to disburse you the 4 million, if you get the example I used. So that's just the tiny difference. With invoice discounting, they will purchase your unpaid invoice, then on the due date of payment you repay them. But with factoring is that you are able to get the third party aware of their existence in the transaction, and when they are aware of the existence in the transaction, they will credit them directly. I just want to be sure that you got me in my explanation. You can give me a chat feedback or not, because I want to be sure. Okay, all right. Okay. Now, so back to the point that I was making about asset financing. So if I take you back to elementary accounting, when you have invoices that are not paid, those invoices are called receivables. Receivables, meaning you've sold on credits, credit receivables, account receivables, trade receivables. So it is using your assets, in this case, which is a receivable, to be able to create funding for your business. So it's still back to what I've said, consistent with these alternatives that they leverage your assets. So you can use your unpaid invoices to be able to generate financing for your business. Let's go to another alternative finance, lease finance. Now, this will speak to, I mean, the best value for lease is when you're going after fixed assets, right? So how does lease financing work? Lease financing works where you can basically get a fixed asset. My reference will be to fixed assets. You can basically get a fixed asset purchased by another organization and grants you the right to use this fixed asset for a duration. So obviously you'll be making periodic payments. So instead of you to somewhat utilize cash or draw down capital from your business and go and fund the purchase of a fixed asset, maybe like a motor vehicle, maybe like some machineries for your business, you can basically approach an organization that can purchase it on your behalf, and you make periodic lease payments to them. So that way it is financing for you. And why I say that is that instead of you spending huge amount of outflow in going to purchase a fixed asset, you are essentially relying on a third party purchasing it on your behalf, and then you're making periodic payments. That's a significant way to ease in cash flow. That's a significant way to acquire assets to use for your business without significant cash outflow going. So that's financing. So a good example is maybe perhaps you wanted to purchase this machinery in your business and it will cost you 5 million naira. So instead of thinking of how to generate 5 million, you can approach a lease financing company who can purchase it, and you'll be making periodic payments. So the difference between how much you could have made in your block payments if you purchased it outrightly and how much you'll be paying periodically every month can be very huge. So think about it as it has created the financing structure for you. Then again, it is an asset-based financing, right? So you can call it lease financing, right? Because obviously the thing with it is that the ownership, and that's the tiny difference, until such whatever the contractual agreement is, if it's an agreement for you to pay the total amount over a period and then you get the ownership of that asset, or it will just be for you to use for the period you want to use. So some lease arrangement can be, if it's for 5 years, you will just be enjoying that asset. After 5 years, you return it back to them. Some can be over 5 years, you then repay the full amount and then you now get full ownership. But whichever way, the point is that you can use lease financing to finance your fixed assets in your business, right? And it helps you minimize the cash flow. That's why we call it a funding or a financing. So what I'm just saying to you is that think about your business and think about many of your fixed assets, right? From furniture to fittings to machineries to motor vehicles. You don't need to get cash drawn out in bulk to purchase those things. You can take advantage of lease arrangements and you still have access to what you want. So I know a lot of small businesses that try to, especially those in production, that try to get giant size generator sets, high-end lister generator sets, right? A fantastic model for them would be to finance through lease. You can approach companies that can purchase that for you, and you make periodic payments that will be quite some significant reduction in your cash flow. So that reduction in cash flow that would have happened if you did an outright purchase would not be there again. So I just thought this is a fantastic way, right? So it's an asset-based financing again, right? Another one which many of you here for contracts might find is very good. Now, this is the use of guarantees. Guarantees, and by extension, another one that goes side by side is the use of performance bonds. Now, how does this work? You might find that you are contracted to provide a service or to deliver on a product. And many a times, what is important to the person who is giving you this contract is the assurance that you deliver on whatever it is you've been contracted to. One way that enhances your ability to get some of these contracts might be to approach a bank and ask for a bank guarantee. Now, with the bank guarantee, it's a commitment, or rather an assurance from the bank to the party that you are going to be contracted to, that should there be any sort of default in delivering, right, that they would somewhat come true, that they will be the ones to make the payments, or they will be the ones to refund, or they make a commitment. Because sometimes it works with like an advance payment. So sometimes you might want to do some certain contracts and you require an advance payment before you then get your full total payment upon completion. So on the part of whoever will be advancing the payment, they might want a guarantee that if we give you this money, you're going to come through, you're going to perform, on this contract and deliver. That is financing. It is financing because with that sort of bank guarantee, it allows you to then go into those transactions. Now, and it works way. There's really no one-size-fits-all arrangement. So sometimes before you even do some sort of this, especially if you're going to be working with big organizations. So imagine you have this project. I remember once I had a client who does events management and was going to do an event of a very big company. She had a fantastic pitch. She just went and pitched, actually. And that might be something some of you in events management can think of doing. From October now, start pitching to some of the corporates that are around you. Just sending proposals on how you would like to run their end of year preacher, because the proposal was very fantastic, right? And she was really adding value in the way she was going to go about it. And then they sent to her that, look, we're happy to work with you, but we'll need a bank guarantee because we actually have never worked with, a business of this magnitude, because it was a small business, but they were happy to invest in, and they asked for a bank guarantee. And then somehow she was able to get a bank guarantee from a bank. And that was how she got the transaction. That is finance, right? It allows you now participate in ticket transactions. And many times, what I do see in my practice is that bank guarantees really will enable you partake in high ticket transactions. So one of the conditions you look out for when you're going for high ticket transactions that can even improve your ability to get a high ticket transaction might be to insert that you can get a bank guarantee, right? Somewhat related to that is also a performance bond. A performance bond is linked, is somewhat like an assurance as well too. In this case, focus on the bond. Performance bond is that you will deliver. I see it a lot with people who get to receive advance payments, that you deliver ultimately when the advance payment has been made and when the contract has been signed. Sometimes it's not even about an advance payment. It's the fact that when you are contracted and you don't deliver, there's an opportunity cost. Sometimes they can blacklist you from being a vendor to those kind of companies. But more importantly is that it gives you credibility and allows you to partake in those transactions, right? So that's funding, right? That's funding, right? And I thought that's something that you can all do and take advantage. So many times you don't necessarily need to imagine that you must get the total amount of funding you need. There are quite some transactions you do that the party who will be contracting you would even make an advance payment to you. So the presence of bank guarantees, performance bonds would help you, get those transactions and get into those contracts. All right. Another one I wanted to explain is tax planning. And some might wonder, how is tax planning a financing model? And I'm going to explain. If you can properly plan and, more importantly, take advantage of strategies that can help you minimize your tax liability, that is funding, because the opposite reaction would have been that you could have paid money for those the tax liabilities associated with that those transactions. Let me explain myself again. It is possible that you could have been going into a transaction that could have had some tax implications. But by doing effective tax planning and effective tax strategy, you would somewhat avoid the associated tax. That savings, by planning properly and understanding the tax implications and not falling into it, is savings, and think about it as funding. You can at least use that money that you would have paid as the tax liabilities and do something else. Let me just share with you a couple of some of the things I think you can do. So for me is, most people don't know that if you don't track your business expenses properly, it can come back haunting. And I'll give you a good example. So tracking your business operating expense, especially with getting the invoices and the documentations for them, there are quite a lot of business related expenses that can be allowed or can be deducted from the profits that are now due for your tax before tax can be applied on it. So the profits that you would actually find as a company or as a business that tax will be applied on,
I think there is an issue with the network. Mr. Ikeolumba. I think there's an issue with the network. Well, sorry about that. I mean, the network is quite really terrible tonight. Sorry about that. Let's see if we can have him back like very soon. But of course, I think while we are waiting for him, we can just take that opportunity to drop our questions in the chat box so that, okay, I think it's back. But we can please just drop our questions in the chat box so that he will begin to attend to those questions as soon as he's done with his presentation. Thank you.
Apologies for that, and I will soon be done. So I'm actually in a location where I feared for my network. But confirm you can hear me.
Yes, we can answer.
Yes, we can hear you.
All right. Okay, so I was just giving you examples of ways you can use tax planning and tax saving to create funding. And it's just to look at it that if you didn't take advantage of these things, you would have paid out a lot more money in your tax liabilities. Let me give you another one, right? So I gave you examples, things like, entertainment expense in your business, fueling expense, transportation, those things, can be deductible for tax purposes. Let me give you another one. If you actually remit your taxes on time, many people don't know this, right? If you remit your taxes on time, so you've got basically as a business, 6 months, right? Between your year end, after your year end, 6 months after your year end to remit your company income tax. Do you know that as a small business, if you remit within 60 to 90 days, put it into perspective, within 2 to 3 months, you can actually get 2% reduction on your tax liabilities. I repeat again, as a small business, as an MSME, if you pay within 2 to 3 months after your year end, the law allows you to take up to 6 months. But if you pay within 2 months to 3 months, you can enjoy up to 2% reduction in your tax liability. That is funding, because if not, you would have paid that money in full. By the time you pay within month 4, month 5, you'll be paying in full. So the 2% reduction is also financing. Another one is if your location where you choose to operate. Sometimes if you choose to operate outside of an urban location, so there are incentives for operating in a rural location. There are incentives for operating in a free trade zone. There are incentives for operating in the export processing zone. Operating in these areas can sometimes allow you to even operate at 0% company income tax. That is financing, because your mates or I mean, a competitor business that was operating outside of this zone would have been paying company income tax at a certain percentage. That is funding. Another one is those of you who want to go into agricultural production. There are lots of fantastic incentives for you on taxes. That is financing that could have been paid. Or you decide to go into designated sectors where you can be designated as a pioneer company, or you partake in some of the export expansion programs the government is doing. All these are tax planning strategies that can allow you save money, and that is funding. There's even incentives for those who utilize gas. So one way the government is trying to promote people using gas to power their businesses. If you use gas to power your business, there are tax incentives for you, which is also financing. So tax planning is a fantastic way to also create funding for yourself. If you can take advantage of all the various tax planning strategies, you can generate funding that could have been paid if you didn't know about this, right? So just to share this with you. And then the final one I'm going to be speaking about is supply, and look at the supply chain as the relationship between the business and its suppliers and the business and its customers. So when I say supply chain financing, what do I mean? If you can take advantage of credit supplies from your supplier, that is one way to get funding. So getting suppliers credits. The alternative is to get advance payment. How many of you know that you can get advance payment from your customers? You can tell your customers to pay pre-order before you deliver. That is funding. That's financing at 0%. So these are alternative ways you can create funding. Back again, all these are linked to your asset side, right? So credit supplies from your supplier is a funding asset based, and getting early payments as well too is an asset-based financing. So I just wanted to share that with you. And then I'm going to wrap up by saying that why are these alternative sources of financing getting very attractive? And there are a lot of reasons for that. One is that this funding now can speak to businesses that don't have a huge asset base. Take, for example, a tech business that wants to do crowdfunding. It doesn't have to be the size of fixed assets that you have to access this funding. Or take, for instance, the bank to look at before they give you funding is what's your credit history, have you performed? Imagine that you're getting early payment from your customers. Does that have anything to do with credit history? Another thing is the associated cost. Some of this funding I've shared with you, tax planning, leasing, these things don't have high interest rates attached to them. And even the turnaround time, which is an important thing with loans or with equity, the time it takes before you can get this funding. Some of this funding, you can get them instantaneously. Getting early payment from your customers can happen instantaneously, right? So just to say to you that one thing about finance is that the lower your risk in the business, right? The lower the risk in the business, the more you can get this funding. This is the final stage, don't worry. To say to you that to access most funding, you know, these are some of the things that you'll be asked. I apologize if I took a lot of the time, right? So it's okay. It's okay. Not the problem. Let me end this way. All right, you stopped me. So go on, take over. Aramide, you stopped me. So take over.
All right, Mr. Ike Olumba. Okay, so I mean, you've shared quite a lot of insightful information tonight. I, in particular, I would even say I wouldn't mind if you can share your slide with everyone here, because I can actually even see a request. But I would like us, because of our time, I'd like us to actually quickly go into the question and answer session. There are some questions in the chat box that I attend to. So somebody says, sorry, to scroll to the question. Okay, but okay, while
All right, so let me just take the question while you check the others. I think the first question we have here is, please, sir, at what point does a business should no longer be called a startup? I don't know how, but I think the person wants to know at what point should a business no longer be called a startup?
Okay. Do you want to read them in batches, or you want me to just take them as it comes? I mean, just guide me and then I'll go on.
Okay, so I think you might just want to respond to that while we get the rest. Then every other person that has a question can then drop theirs as well.
really
Okay.
sorry, the network is really terrible.
Yeah. But if you can hear me, I can go on. I just want to be sure it's not from my end as well.
We can hear you,
Okay.
Jonathan. We can hear you.
Okay. So you know, I like that question that was asked about at what stage would you consider a business not to be a startup? So because sometimes those words are really abused, right? So the real concept really, and I'm going to take you back to the fundamentals, the real concept around the startup literally comes from the word starting up, right? Just starting, right? So startups are businesses that are just about starting. One of the things you would notice about them is that they are still trying to get market validation about their ideas, their products, and their services, right? So once traction begins to happen, then we like to say that that is a growing business, right? Or that is a growing business. Once traction, and that's why sometimes when you work with certain kind of investors, there are metrics that they will begin. So many of the metrics, how many customers have you onboarded? What are the number of products, you know, even from a financial standpoint, right? What has been your revenue growth month on month or year on year? Once traction begins to happen, then you would then say that's a business at its growth stage. Because there's a concept of what I'll call, if you'd like me to explain, what I'll call a business life cycle, right? Just similar to something like this, right? That a business you find that it starts, then after starting, it gets to the growth stage, which is quite rapid, then it gets to maturity stage. So once traction begins to happen, and especially growth in all the baseline indices that has been agreed, right? Then you then say that's a growing business. So you are no longer a startup once, you know, growth is happening across, you know, key metrics, right? Growth in the number of clients that you're currently having, growth in the number of products, growth even in your year on year and your previous revenue. The big picture is that there's already market acceptance now. So once the market has accepted your products or your service, you don't qualify again as a startup. But I know that there are quite a lot of very seasoned people on the house who might even want to add more, you know, to what I'm saying. I know people like Sheye, Madam Fayo, Madam Funta are all on the call. So they might also want to add more, but that's my take on being a startup.
All right, thank you, sir. So the next question says, how can one access the bank guarantee? Are there certain criteria necessary before a bank can issue the guarantee? All
right. So I think the first thing is that it then really, I mean, it fluctuates from bank to bank. But let me be clear on something, right? And I'll be very, I mean, I was a banker for 10 years, so I can share this with you. One of the things that I want you to know is that the banks themselves, because really, once there's a bank guarantee, apart from the fact that it adds credibility now on the part of whoever wants to go into those transactions, I mean, it adds assurance, it adds credibility. But the bank themselves as well too, we ensure it's a risk management tool for you, but also for the banks, they too will protect themselves. So most times, what usually happens in reality is before you can get that bank guarantee, the bank themselves too will want to ensure that the funding that is linked to the transaction that you are trying to go into, that the assurance of the presence of that funding happening is true. I'll give you a common example. So sometimes you want a bank guarantee, there might be a lien. So you might have, so I'll give you a good example of some that I've seen. So you might find that you have a couple of accounts with the banks. And maybe if they do the totality of all the amounts in the various accounts you have with the bank, and it maybe adds up to what they are looking out for, the bank might be happy to say, okay, we'll give a guarantee, we'll put a lien or we'll place a PND on your account for that duration, right? Or you might be a business that does a significant amount of cash flow. And if the amount that you want to go into the transaction falls within your recovering cash flows with the bank, they're happy to do a guarantee on that. My point is that before the bank will give you the guarantee, they will want to hedge their own risk as well too, by ensuring that they've got all the assurances in place that, you might be able to, that there'll be no default on their part, because essentially they don't want to pass the risk from you to them. I think someone's hand is up.
All right.
Okay.
Yes, I think we
Okay.
can take Mrs. Fire Williams, because
Yeah.
I can see her hand is raised.
Yeah.
You may please go ahead, ma.
Yes, good evening. Good evening,
evening,
everyone.
Ma.
Good evening,
And
ma'am.
thank you so
Good
much,
evening, Ma.
Jonathan. Good evening, Nara. How's everything? Yeah.
Fine, thank
I
you,
just
Ma.
wanted to first salute Jonathan for that awesome delivery, and to thank Mr. Shayelu Arutmi for, even bringing this platform to birth, because I think it's so important to help SMEs. So my little contribution is on this issue of the performance management, performance bond, bank guarantee and the performance bond. With regards to bank guarantee, I found out that mostly it's been asked for in tenders and bids. I don't know whether Jonathan will agree with me.
Yes, I said so. Yeah.
So you have them for these state governments, World Bank, AFDB kind of projects, and they ask for a bank guarantee. And I found out that there are two forms that are popular. Either the bank, like you said, they want to hedge their risk, so they may insist that the guarantee they're going to raise, do you have a cash backing?
Yeah.
And then I look at them like, are you crazy? If I had a cash backing, I wouldn't be here, But there are some other banks who charge a fee. So my advice to everybody on this call is that if you ever need this bank guarantee, I can't advertise for any particular bank because yes, I know their names. These are things I've done, but you need to go shopping for a bank that can give you at a percentage. They'll take a percentage of that bank guarantee. You pay the fee and you get the guarantee. Now, when it comes to performance bond, another little contribution is that I was able to get one from an insurance company.
Yeah.
And they charged only like 1% of the total amount involved. So I think insurance, if you want to talk more about that, you've been talking about non-financial institutions and financial institutions. So if you want to, say a little bit, many of us don't know. I have borrowed money against my insurance policy just because I wanted to know whether it's possible. So I went there and I got money. And I also got this performance bond at 1%, which I felt was very reasonable. Thank you.
Yeah, thank you, Ma. And just to add, right, you know that the bigger picture with this is really a risk management tool. So that's why you find that because of the nature of insurance in itself, which is really risk management. So I agree with her absolutely that, you can find not just the banks really. And that's why sometimes I use words like
Okay, I think the network again is really affecting Mr. Jonathan as well on his end. We're really sorry about this. Sorry about the time and all of that. The network is a bit crappy right now. But I guess you can just keep dropping your questions in the chat box so that when it comes, we can just pick them one after the other.
Okay. All right, so while we wait for Mr. Jonathan to come back, I would like to announce to everyone who has been asking questions about the recording that yes, it will be available on our YouTube channel. So please, you can subscribe to our YouTube channel now to catch a recording of this meeting tonight. So I'm dropping the link now. So you might subscribe, you get notified, and we have other past editions that we have on the YouTube channel as well. And if you're interested in joining the MSME community, if you're not yet a member of our community, you might also want to do that right away. I'll drop the link as well. So please, for all your subsequent questions, you can also drop them on the YouTube channel. Thank you.
We'll soon be coming home, Daddy. Yes, sir.
Media, please, can you help me mute?
Mr. Yes, Mr. I can hear you. Mr. Jonathan, you may please continue.
Okay. I try to, yeah. Okay. So I thought she did brilliantly with the point she was making on the bank guarantees and performance bond. So what I'll just say really in passing, or as my final take, would just be that financing, whether it's traditional or alternative, it's not emotional. I mean, that's the point I like to make, that no business has a better case for money than another business, right? So it's about value. So once you are clear that there's value proposition, once you are clear that you're committed to value creation, I think you will find it very easy to access, funding, right? And also just think creatively, right? For me, the trust of everything I'm going to say about alternative finance is that it is really leveraging your assets a bit more, right? And just thinking about how you can take advantage of some of your assets, whether tangible or intangible assets that you have in the business. I think that's where I'm going to end it. But I'm happy to take any questions later on. I'm on the WhatsApp group, and it's always a pleasure. I'm also a member of the family. So I think thanks for that. That'll be it for my end.
Okay, I think because of our time, we might not be able to take more questions, but we would like to appreciate Mr. Jonathan Ike Olumba for that wonderful, amazing presentation there. Thank you so much for joining us tonight. Okay, so I want to call Mercy now. All right, sir. Mercy, could you please just give us the announcement, the general announcement quickly?
Okay. So thank you, weekly community group. So I dropped the link earlier. Anyone who is interested, who's not yet a member of the community, can join. And of course, you can join. You can subscribe to our YouTube channel for other editions of our programs as well. So you can always catch a replay, a rewatch as many times as you like. You can drop your comments and questions even in the comment section there as well. It will be attended to. So thank you all so much for joining us this evening, and that will be it. Thank you.
All right, thank you so much, Mercy. Before we draw the curtains tonight, we'd like to invite Mr. Shaya once again to give us his closing remarks.
Okay, thank you so very much, everyone. It's been a good evening. And somebody once asked me, why do you hold your BGS in the evenings on Fridays? Do you think people will attend? And sincerely, I don't have an answer, but we can see we have close to 90 people here. We have about 20 on YouTube. And I just want to say thank you to everyone who has always been a part of this. I want to appreciate Mr. Jonathan Ike Olumba. Thank you very, very much for honoring us. And the quality of the delivery tonight is I don't know how to explain it, but you can see the comments in the chat box. Thank you so much, everyone. For those who are asking for the recording and the slides, so you have more than the slide now. You can go to our YouTube channel and watch a replay right away. You don't even need to wait for anybody to send you a link because we are streaming live. So as soon as it ends, you can always access it over as many times as possible. And then also subscribe to the YouTube channel so that you get a prompt every time we have a new video.